A business credit card looks almost identical to a personal one, but behind the scenes, it works differently in a few important ways. And those differences are exactly the parts most business owners never get told or learn. Here is how they really work. At the basic level, a business credit card is a revolving line of credit in your business's name. You make purchases, you get a monthly statement, you pay at least the minimum, and if you carry a balance, you pay interest on it. That part is familiar. It is what sits underneath that matters. The first thing to understand is the personal guarantee. Most business credit cards, especially for small businesses, require you to personally guarantee the debt. That means when you sign up, you are promising that if the business cannot pay, you will. The card may be in the business's name, but you are personally on the hook behind it. Whew. This is the single most important thing to understand before you get one, and it is rarely in the headline. The second thing is how the card reports. This varies by issuer, and it matters a lot. Some business cards report your activity to the business credit bureaus, which is how the card helps build your business credit. Some report primarily to your personal credit, and some only show up on your personal credit if something goes wrong, like a default. Whether a card builds your business credit depends entirely on how that specific issuer reports. So if building business credit is your goal, this is the question to ask before applying. Now the advantages, because there are real ones. The first is cash flow timing. Between the moment you make a purchase and the day the statement is due, you have a short window where the business has the goods or service but has not yet paid, a built-in float that can smooth out the timing gaps we talked about in cash flow. The second is separation. Running business spending through a business card cleanly divides business expenses from personal ones, which makes your bookkeeping cleaner and your documentation clearer. And that separation has value well beyond the card itself. And the honest cautions. If you carry a balance, business card interest can be steep, and because of the personal guarantee, business card debt can follow you personally if the business cannot cover it. And the separation benefit only works if you keep it clean. The moment you start putting personal spending on the business card, you undermine the very separation that made it useful. So here is the honest takeaway. A business credit card is a genuinely useful tool. For cash flow timing, for separating your finances, and for building business credit. But it is only as good as your understanding of two things the issuer won't emphasize: that you are personally guaranteeing it and how it actually reports. Know those two things, and it becomes a tool that works for you instead of a surprise waiting to happen.